What's up guys? Simon here. In this video, we're going to go ahead and talk about the coming recession, what it's going to mean for the stock prices, and what has happened in the past with recessions that we have had in the 21st century and some of the ones before. So it's coming. We know it's coming. Recently, the GDP numbers were released and we were 1.4% down on the GDP when the Feds expected it to rise by about 1%. So what does this mean for everybody? It means that the recession is coming, it's inevitable, and we may see it sooner than we think. Before I get into this video, I remind you guys, hit the like button, subscribe to the channel, and I appreciate it. So let's get into this video. So the gross domestic product, the GDP has fallen 1.4%. This is the first time it's fallen since the growth we've seen since 1984 on a pace that we have never seen before. Now, of course, there was a recession in 2020 amid the COVID era, and that recession lasted nearly 2 months with the worst decline in U.S. history. In the 2020 recession, the U.S. economy contracted by a whopping 31.2% in the second quarter, while falling 5.1% in the first quarter. And then the Feds printed a lot of money to combat that recession and that loss of GDP. In April of 2020, the economy lost an astounding 20.5 million jobs, sending that unemployment rate skyrocketing to nearly 15% at 14.7%. And that economy and the jobless unemployment rate went all the way through August of 2020. To combat that, the Feds lowered their interest rate, or the Fed's fund rate, to 0%. And they decided to keep it there until 2023. Congress obviously issued billions and billions of dollars of aid. And although the economy grew 33.8 or 34% in the third quarter, it was not enough to make up the earlier losses. So recession is something that we have experienced before. I personally have experienced it, and I know you guys have as well. But the crazy thing that's happening now is the economy missed the GDP by 1.4% when they expected it to grow by 1% with the higher interest rates that they have set out. So this is not a 1.4% swing. It's actually a 2.4% swing in the opposite direction. So this is not good news at all, guys. On top of the recession worries, prices have increased with inflation. So we're seeing a bear market and a recession potential market everywhere. So prices are up about 8.1% or so, with the GDP price index following a 7.1% jump in quarter 4 of 2021. On top of the recession woes, and some signs we're seeing here are a deceleration of private inventory investments, also less government spending in both the federal and the state level, rising import costs and less exports, an 8.5% pullback on defense spending. That pretty much knocked a lot of spending off the GDP already. Consumer spending accounts about 2/3 of the economy, so we were able to help counteract some of that government spending or lack of spending. And consumer spending somehow held up very well, considering that unemployment is still not at its peak. But keep in mind, the trade deficit that the U.S. has not favored the GDP at all. So with all those factors, a negative trade deficit, less spending in both consumer sectors, federal government, and local and state governments, this cannot sustain, and it will affect not only the stock market, but the overall recession as a whole. Now, personal consumption expenditure prices have risen way above the bank's estimate of 2% at a total of 5.2% in the quarter. That means everything costs more, including everyday expenditures such as food, gas, etc. So everything that you're using for daily life costs more. Yet your salaries and your net profits are not increasing with the level of the inflation. What's happening is the economy is shrinking, yet everything is costing more. And current market pricing is indicating that the Fed's interest rate will be at about 2.75%. Now that is 2.75% more than they had at 0% during the pandemic, when they were having net zero rates, allowing for recovery from one of the toughest years in history. Now, Goldman Sachs credit card I just reviewed also estimates that there's a 35% chance of negative growth this year from now on. They see a significant recession hitting in late 2023, early 2024. Now, I ask you guys, if we're headed towards a significant recession with inflation rising, why are the Feds raising interest rates and not trying to combat that recession that is potentially coming? This all comes so fast. After a year, the GDP rose at 5.7%, the highest increase since 1984, of course, post-pandemic. Now, while consumer expenditures drove that inflation or the GDP rise at nearly 70%, or accounting of 5.7% of that growth during the first half of 2021, that number is decreasing to the first quarter of 2022. Sustaining GDP growth or counterbalancing GDP growth is going to require that we have a steady supply chain, a possibly lower interest rate than the one we're seeing now, which they keep raising every 6 months. And we need to understand what's going to happen with a potential job market that's still not fulfilled, with a lot of individuals still not wanting to go back to work. Now, historically, in 2001, we've seen a recession that lasted nearly 8 months, from March to November. It was caused by the dot-com bust or boom, and it was called the Y2K recession. Y2K scare had a lot of companies panicking and worried, as well as investors on Wall Street. People were afraid that the old systems and computers would not know how to act, possibly causing a bank shutdown, with the year turning to 2000. Then the 9/11 attack occurred. That worsened the recession, and the economy went down for 2 quarters by about 1.3% and 1.6% in the second quarter. Unemployment continued rising to the peaks of 6.3% until June 2003. However, we got out of that recession and then went into a even bigger recession in 2008-2009. The 2008-2009 recession was called also a Great Recession because it severely crippled the housing market. And it was the biggest single recession since the Great Depression. That recession was one of the longest as well. It lasted nearly 2 years. The global bank crisis, lending people money that could not afford housing, taking insurance policies against those people that cannot pay, then foreclosing on all these properties, really crashed the market. It crashed the housing market, and it made a lot of people lose a lot of money. The damage spread to the general economy, to the consumer. The GDP shrank so much it included a nearly 8.5% drop in the fourth quarter of 2008. The unemployment rose nearly 10% in October of 2009. And that was one of the craziest experiences we have seen in America. Now, we haven't had really a recession up until 2000, when COVID hit. Everybody shut down. People were forced to work from home. Businesses were closing, etc. And now we are on the cusp of potentially a recession that has been looming for a long time, that was corrected in 2000 or 2001 by the Feds printing so much money, and it cannot sustain itself because all the other factors around this recession are leading to a recession that have not been addressed. The supply chains, the negative GDP growth, poor job results, rising interest rates, possible foreclosures looming. There are so many factors that are potentially going to start crashing the market. You have to prepare. So how does the stock market get affected by these recessions that are looming, coming, etc.? Well, we've seen the stock market react in 2000 to the COVID recession. You get a sudden economic shock or a sudden stock market shock, which caused the stock market to go down. With the recession, you're going to get excessive debt. People and companies are going to realize there's excessive debt because they have taken out money on things that they cannot afford or do not need. You cannot take out so much debt and count on the market to bail you out and continue rising when the market is heading for a downturn. Now, the stock market, although has done really well even up until this point, is seeing some effects of the potential recession coming and the interest rate hikes. We're going to see even worse recession results as we get closer to 2023 because of the fact that we're continuously not sustaining what we need to be doing in order to combat recession. In fact, we are helping or aiding a recession by continuously having higher interest rates. So it's been nearly 13 years since a real recession has hit our market. We are well overdue for a recession, and a recession typically happens about every 10 to 12 years. If we do enter the recession, on average, the S&P 500 nearly drops 30% during recessions. It is a great time to be cash liquid heavy in case you will be making investments into real estate, into the stock market, into anything that you could buy at a discount. In 2007 and 2009, the max drawdown of recession or the stock market or the total collapse was nearly 57%. That means that you would lose more than half of your portfolio of assets or anything that you would own. That's how bad the 2007 to 2009 recession was. In the February to April 2020 recession, the drawdown was 34%. That means investors saw a decline of 34% of their assets for that short 2-month period. Now, if we compare these stats to the 2007-2009, you will see that people lost 57% for nearly 2 years. Those that could not hold out during that period of time were really in big trouble. So if you're not liquid or cash heavy during recession times, you are in big trouble. The biggest drop was ever in 2007 to 2009. That was even a bigger drop than the Great Depression. So the recession is coming. My advice is stay cash heavy, stay liquid heavy. If you have assets, you may want to consider selling them after consulting with the proper people. But being cash positive or cash heavy during recession times just gives you a whopping amount of opportunity to really purchase whatever you want and make money on that as the markets turn. If the markets turn within a year or within 6 months, you've made 30 or 40% back on your recession, depending how big of the drawback we're going to experience this recession. And guess what? With the inflated prices, with a lot of inflation happening and bear markets still going, we're going to see some weird mix of potential drawbacks that we may not have seen before. I personally think that it is a great idea to have some investment money ready for any type of recession that is going to come. And guess what? It's coming. So the stock market's going to feel it. The real estate market's going to feel it. And you're going to feel it in your pockets, unfortunately. Comment below. Let me know what you think about the GDP growth declining versus rising. What do you think the Fed should do with the interest rate? Should they continue to raise their prime rate? Or should we, at this point, see a tailback on the interest rate increases to counter this recession that could potentially come? As always, I appreciate you guys watching. Hit the like button, subscribe to the channel if you haven't done so already, and I'll catch you here in the next video. I just hope we survive the next big recession together.